Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, fund analyst from Scope Analysis. I will be the moderator for today's webinar. Today, we will tap into emerging market fixed income. On the one hand, governments and companies in developing nations borrowed on foreign markets at a record pace in early 2021. Investment inflows demonstrate strong demand for emerging market corporates, attractive carry, and comparatively low duration. On the other hand, we see sharp rise in interest rate. The credit class experienced a difficult February in reflection of a sharp rise and continuous upward trend in U.S. Treasury bond yields. Risks are mounting as some countries endure a resurgence of coronavirus. Should investors warrant positive secular outlook and keep allocating capital into emerging market bonds despite all? For this, I'm very pleased to be joined by our guest speaker, Warren Hyland, Portfolio Manager in Emerging Markets at Mucinich & Co. He's joining us on the line from London. Welcome, Warren.
Good morning, everybody.
The discussion will last about 45 minutes, including a Q&A session if time permits. While I encourage all of you, our audience, to write down your questions, you could also review the full clip of replay on our platform, Scope Explorer. Without further ado, let's just get right into starting with a question on Warren yourself. Tell us about yourself. How long have you been with Mucinich, and what's your background relevant to this asset class and emerging markets in particular?
Well, I started my career in 1997 as a maths graduate, I very early on trained as a sovereign analyst, my career progressed from there, and I joined Mucinich in 2013 as their EM employee number one to build out their capabilities and solutions for clients' requests in emerging markets.
Thank you. So before we dive deeper, would you give us a snapshot of emerging market fixed income landscape for our European investors who are interested to look outside the US? What are the ways to allocate to the asset class? What do you mean when you say emerging markets can make the impossible triangle possible?
Okay, yeah. So emerging market, I work in the fixed income area, not equity. So we're going to discuss just fixed income today. And it can be broken down into local markets and hard currency markets. And these are very different. Local markets are where the fixed income instruments are denominated in the local currency. So if you bought a Brazilian sovereign bond in local, you'd buy it in Brazilian real. That market's the most volatile, and it's the most driven by macro environment. Mucinich and myself, we specialize on the hard currency. What's the hard currency? That's really where countries and corporates, they predominantly issue in dollar-denominated debt. So if you brought a Brazilian sovereign bond and it was hard currency, it'd be issued in the US dollars. And realistically, 90% of the hard currency world is in dollars, and 10% is between really euros and a little bit of sterling and Swiss francs. It's quite a big universe. If we look at the hard currency universe, it's around 3 trillion. Sovereigns about 1.2 trillion, and the corporates is now larger at 1.8 trillion. You break it down, that's around 600 billion in high yield. As a comparison, European high yield is around 450 billion, so it's larger than European high yield. And the IG is about 1.2 trillion. I guess what differentiates EM from developed markets such as Europe or the US is that there's no real split between differentiation between IG markets and high yield markets. If an investor invests in EM, they get exposure to both IG and high yield in the same portfolio or fund, where it's separated in developed markets. Issuance on an annual basis is around 500 billion in the corporate space, where we really at Mucinich we specialize. And according to JP Morgan, the daily estimated trade flows of securities bought and sold is between 4 to 5 billion. So it's a large market, and actually over that I would say over the last few years, it's kind of stabilized at the current sort of levels. By that I mean is that if we look at net supply, it's pretty neutral, i.e. if we take away bonds maturing and coupons paid, it equals roughly what the supply into the new issue market is.
Okay, so looking back, another question. So looking back, government bonds were considered unattractive assets, especially for developed markets, which you just mentioned, where yields are low and prices expensive. Are emerging markets now in the sweet spot compared to developed markets for hunting better yields? What is your view on EM government versus EM corporate?
Yeah, that's an interesting one, isn't it? I mean, we're we're off the highs in terms of negative yield now, aren't we? I think it peaked around 18 trillion, and we're about 13 trillion now. And also, what's worth pointing out, if we look at or we analyze money market funds, their AUM is at abnormal high levels. So cash is not only being invested in these negative yielding bonds, it's almost a nominal large amount is being still sits in cash. So it's inevitable in the sort of economic environment we're in now, reflationary, where we're seeing sort of record growth levels, that some of this cash and negative yield assets is going to not become favorable, and it's going to be pushed into other areas. And yeah, you would expect that emerging markets would possibly be an area people would look. As you said, you always get slightly paid more. I think if we look at how the balance sheets of sovereigns and corporates are going to develop over time, one big difference this year is that we see a significant improvement in balance sheets in corporates versus sovereigns, which are stable. And that's driven by cash flows. If you think of a corporate in 2020, its revenue stream collapsed. But to combat that, they basically cut capex, they reduce costs, and sort of that loss of revenue stream is really what drove up the leverage. And if we take EM as a universe, it moved up about half a turn of leverage from 2.5 to 3. But if we see what's happening this year, is that revenue stream has come back as sort of, global growth picked up, volumes pick up, prices are picking up. And so what's actually happening is that the corporates are now deleveraging because they've not increased their capex cycle and they've not increased their spending. So we have a scenario now where actually the balance sheets in the corporate space is starting to improve, and we're starting that better part of the cycle where you get upgrades. That's not the case in the sovereign for this year. If we look at them last year, they also had a huge reduction in their revenue from taxes as the economies went into recession. But they couldn't cut costs. They had to increase They had to increase their expenditure to support the economy. And actually, one of the areas where they really wanted to support was the corporate space, in the sense that if you can stop people becoming unemployed, then the economy will recover. And it really was one of the initiatives globally to keep people employed through various support schemes. So corporates were part of the solution here. If we move, so both their revenue slowed and their expenditure expanded. And this year, obviously, their revenues are coming back, but their expenditure still stands out. So we're not seeing improvement in balance sheets in sovereigns. So within Musenich, within sort of allocation, we have a preference to own corporates over sovereigns on a fundamental basis this year. And I generally agree with you. In the current sort of reflationary environment we sit in, EM looks an attractive asset class, especially versus negative yielding government bonds and high cash balances. Okay,
so now let's talk about valuation. How does the valuation in EM corporate credit look like? Are they still considered attractive, for example, given the sharp rally in Asia credit spreads over the recent months?
Yeah, it's fair to say if we look at it through various matrix, if we look at valuations on a short-term quantitative approach using they stand at the bottom of their fair value range. They're kind of 1 Z-score expensive, where you would expect them to be sort of 68% of the time in that range. So it's not cheap. But you could argue that that's probably fair, considering the environment we're in, where we have ultra low monetary policy, ultra supportive fiscal policy. Central banks continue with their reflation. Liquidity is abundant. Economic growth, if we think about that, sort of EM will grow at 7.5%, global economy 6.5%, well above long-term potential. It's understandable that credit spreads are at the tighter end of the fair value range. If we look at it on more medium-term basis, and we apply sort of default expectations, which in EM is about 2.5%, it gives you a high yield spread of about 450, which is roughly where the market is. So I would say on a short-term and long-term basis, there isn't that much compelling value, but it's not expensive. I guess what differentiates EM is to developed markets, and year to date, EM has underperformed to an extent developed markets. So when we look at EM versus developed markets, it does look optically good value. You're still paid around 50-60 basis points to switch from developed markets IG into EM IG, and around 150 basis points to do the same switch into high yield. So valuations everywhere aren't cheap, but on a relative basis, EM looks quite constructive. And I imagine the significant reason we've seen flows year to date is along them lines, that combination of the reflationary environment and a relative value. In Asia particularly, it's been a sort of volatile sort of start to the year. We always get that seasonal strong issuance at the start of Q1, and then that's followed by basically a period of basically no supply where we are now. So technically you find that Asia basically starts the year under a little bit of technical pressure, but as that sort of supply basically sidelines itself, you sort of you find there's mean reversion, and really that's what's really occurred over the last sort of 4 to 5 weeks there.
Okay, so let's steer to your strategy, Mucinich Emerging Market Corporate Debt Fund. How do you define the universe of this strategy? Where do you see value across sectors at the moment? What makes your strategy stand out compared to your peers?
Yeah, at Mucinich we have think when I started, what I showed the sort of the management team was the impossible triangle we find in emerging markets, and people are always going to be attracted to emerging markets because of the higher coupon. So and then fund managers or strategies fall into the trap of making sure that promising clients all the upside potential, and at the same time basically promising them the protection to the downside. And it's kind of an impossible triangle. You can't provide all the upside and none of the downside. So what we did at Mucinich, we split strategies. So we've only got one objective, and so we have one objective for each strategy. So you can have the short duration, emerging market short duration, which gives you that superior coupon, but it's defensive. It's designed to protect you from the downside. It's a capital preservation strategy. It's sort of over the 7 to 8 years we've been running, it generates a 4 to 5% dollar return. But a number of people really would like the capital gains, which you can often find in emerging markets. So the polar opposite, we've opened the emerging market corporate debt fund, which really concentrates on basically the upside, gathering all the growth potential in emerging markets, and worrying less about the downside. And so that's a far more capital gain seeking strategy. And over the 3 years we've been running that's average around 8-9%. So I think what differentiates Mucinich is that we basically have a very simple philosophy. If you want to go into emerging markets for that superior coupon, but you're concerned about the downside, buy a short duration strategy, because we're concerned about it there. If you want to go into emerging markets because that superior coupon, because you think there's upside potential, we have the strategy for that, and we don't mix that impossible triangle.
Nice. So due to relatively limited research coverage, and navigating emerging markets always requires much more resource and country affinity. Could you introduce to us about your investment process? How do you decide on for example, country allocation? And what are the traits of the bonds that can make it to your portfolio?
Well, that's going to take a long time to explain the entire process.
Tell us about the highlights.
So I think the thing to understand is that when you break down an emerging market corporate bond, you've got a number of risk premiums. And the first risk premium is your interest rate risk premium. And we look at that through our global asset allocation meeting, where we discuss moving forward the the global growth, inflation, geopolitics, and scenarios ahead of us. The second risk premium is the corporate risk premium, and that really is the heart of what Musenich does. And when you look at a corporate risk premium, it's made up of three things. It's made up of the company itself. It's made up of the sector it's in, and it's made up of the sovereign that the company is in. And you need to break these down, these three different components, to build up an understanding of that risk premium. And that's the heart of the bottom-up process for us. And the final risk premium you find embedded within the bond will be the liquidity volatility of the bond, which you can look at on a top-down basis in terms of how much beta you want in the portfolio, or the bottom-up, where you look at it from a single name credit. I guess the key at Musenich, and the key for emerging markets, to sort of widen your question, it really is that corporate risk. And that's where Musenich specializes, and that's where a significant amount of our resources are. And so if we break down what we're really doing here, the key thing first is to understand the company. Now we have specialists in all regions, in emerging markets, in Asia, in Europe, and in Latin America. And it's key that they speak the languages, understand the culture. And prior to lockdown, they basically, the research involved traveling to meet the companies on site.
Yeah. So you just talk about risk premium. So speaking of risk, let's move on to risk management. How does the strategy integrate long-term conviction investing with the downside protection? What do you think about overall risk for the portfolio? And I think in terms of country allocation, there's a question from the audience regarding India's current situation. There's a new and ferocious wave of corona threatens its recovery. What's your view on the current situation and on India, and what impact does it have for your strategy? Maybe you could elaborate more on this example to help us to understand the logic.
Sure. Can you hear me?
Yes.
Yes. Sorry, my screen suddenly went mute and switched off. Okay, India. It clearly is in a terrible situation from the humanitarian point of view, and there's nothing we can add further to that. And I simply hope that we're already seeing this sort of peak in the wave there. Fingers crossed. And if we step away from that tragedy and think of it more in the cold light of day as a capitalist investor, the first thing which is interesting is that I expected, the Indian equity and credit markets to have sold off during this second wave, but that's not been the case. There has been hardly any sort of a widening of spreads within the region, and sort of why is that the case is key, right? And the reason is there hasn't been a sort of a national lockdown. Things have continued to an extent as they were prior to the second wave, and by that I mean that if we break the Indian economy down, its agriculture and manufacturing was full steam ahead. Its service sector was still lagging as it was recovering, and we see that through the latest PMIs. If we look at the April PMIs, it came in at 55.5, i.e. above 50 is expanding, and that's slightly higher than where it was in March. Of course, we will see some slowdown, and the anecdotal evidence people look at, such as diesel consumption, power consumption, mobile connections. It really is from a peak which we saw in March, down 7%. We compare that to this time last year, and it was down 25%. So to date, there hasn't really been what I would say that a draconian lockdown as we saw last year, and that's probably why we've not seen assets falling to an extent. And although it can be done on a state-by-state basis, I think it's almost worth pointing out as well that 50 to 60% of the Indian population are informal. That is, they're not actually on a payroll, and a significant amount of them work in the agriculture industry. And sort of end of May, June is the planting season seasonally, and you can't stop that. It's very similar to last year. What they opened everything up in June simply because they had no choice. So I don't perceive to see that there will be a significant lockdown moving forward. On the positive, let's look at the positive. People forget because they just look at the sort of the numbers in terms of the demographics of India. So, the population above 60 is only 132 million. And last time I looked, just a couple of days ago, they have actually vaccinated 150 million people. And, the government's target is to move up. It's currently rolling at 2 to 3 million vaccinations a day, and the government estimates it wants to move that up to 6 million a day. And it seems by the summer, they easily vaccinate everyone above 50, which is 250 million. So it is a very young population. So fingers crossed that goes ahead. And as a significant amount of the vaccines is made in India, and now all manufacturers have to offer at least 50% of their supply to the Indian domestic markets at international prices, I see it's possible. So I'm hoping, similar as people was very nervous about Brazil, through March, April, India's a similar scenario, maybe a sort of 6 to 8 weeks behind, and hopefully we'll start to see the peak in their second wave this month. And a combination of strong vaccination program and herd immunity, by June, July, we start to see a significant reduction. But overall, prices haven't moved particularly much yet. And that's because I think it's now becoming consensus that they won't be national lockdowns. Yeah. Does that help on that question? I think so.
Yes, certainly. Yes, certainly. I think it's a very insightful idea and insightful knowledge that we get from your understanding on the current situation in India, and certainly helps us to understand logic on your, how to understand the risk side. Our next question addressed some concerns from our audience who are not so familiar with the region. Many investors are cautious when it comes to investing in emerging markets, even though over the past year, governments in the region have made a lot of efforts on internationalizing and reforming their capital markets. However, many companies in those markets still have problems with regards to corporate governance or as state-owned companies. Could you weigh in on those concerns? Do you think the market is mature enough already for foreseeable hyped attention with, in a global context with tighter scrutiny? What are the opportunities there?
At Musenich, we're concerned as well, right? And that's what we do, right? We look at the companies on a one-by-one basis. We understand the management. If we're not convinced the management can achieve their objectives, failed track records, we won't invest in it. We build cash flow models for the company, and basically tweak them. Accountants are very good at making things look beautiful. That's my opinion. But what happens if you build a cash flow model for a company and you tweak its revenue, give it a price fall 10%, volume fall 20%, currency deval 20%, working capital expansion, CapEx expansion? We're looking to see if these companies become unstable when an event that you don't expect occurs, and then obviously we'd look at the covenants to make sure we're covered for the simple things, such as the management can't dividend stream the money away. The management can't leverage to the moon. So, at the core of it, is that bottom-up credit analysis, which our team do on each individual company, and we follow them for many years. I think a certain amount of fear factor, and then, in a certain amount of fear factor, clearly at Musenich, if you're really concerned about EM, we have our short-term strategy, which is very capital preservation. And by definition, we are most concerned of these issues. But if we step back and just look at the brutal numbers, and I guess 2020 was a great year for that, because that was a year where, there was very high level of stress in the markets, and it was a default peak for the cycle, and EM defaults were 3.5%, and that compares to US defaults of 6.8% and European defaults of 3.3%. So in terms of and why did EM do relatively well, especially versus the US, and very similar to Europe? And that is because if you look at majority of EM corporates, the balance sheets are, because they're used to going through abruptly more volatile cycles, you'll find that the management keep their balance sheets more conservative. So they generally, in periods of stress, you'll find they'll have more cash on their balance sheet, less leverage, less structure underlying their businesses in terms of structured products. So you find that actually in that environment, they're quite robust.
Okay, so we're seeing a slide that's showing. Okay, so let's move on to policymakers. What do you think about the fear of risk around corporate defaults triggered by words on the street that central banks will pull back stimulus? For example, in China, PBOC has already started to do this very kind of stringent targeted lending. Are there areas of the markets where you're especially concerned about?
Of course, one of the drivers of the next weakening in risk sentiment will be when policy adjustment is tightened. And so, although if we look at the major central banks across the world, they have communicated very clearly that that's not a part of their agenda over for 2020. That said, it'd be interesting to see if the bond vigilantes come out as we get that what is seen by majority of people, short-term inflation spikes in the coming sort of 2 quarters. On China particularly, monetary policy is not their favorite tool. They're stronger, they're much better in terms of a regulation. And we've seen over the last I guess 9 months now, a tightening of regulation. They call it the prudent macro measures, and they first targeted the property sector, where I think it's a very important initiative done at the right time. And as we're seeing global house prices everywhere in the world rising, I wished more would follow China's example here. And what China have done, that they've actually said to the property developers, we have 3 matrix that you must bring in line. They're called the 3 red lines. The first one being that cash must be greater than short-term debt. The second one, leverage must be below 100%. And the third one, that your liabilities can only be 70% of your assets. Now, if you breach all 3 of these, you're not allowed to increase your gross borrowing. So it's quite penal for the actual companies. And this was timed extremely well for, in my opinion, because if we take the second half, if we take 2020, the second half of 2020, the second half in 2019 and 2020, property sales was enormous in China. December 20 was the first 2 trillion renminbi month. So if you take that standard 18-month cycle, all the cash is now coming onto the balance sheets from the property sales now. Normally they'd go and buy land banks and leverage themselves up, but they can't now. They've got to use that cash to bring their matrix in line with the government regulation. So we're seeing a very strong deleveraging, improving of credit matrix in the Chinese property sector. And that's excellent news, in my opinion. Firstly, because increased transparency, we know exactly what the property companies need to do and which are the important matrix. Secondly, the companies are abiding by this, and we're seeing as the cash flow comes in, deleveraging. So we're really constructive in the property sector in China because of that. The second regulation really is driven really at local government financial vehicles, where the government is starting to pull support away from these, and we agree zombie entities shouldn't exist. They're not productive, and actually, if you look at these companies or these vehicles on a standalone basis, and you've done your credit work, they don't make much sense. Their credit matrix are awful. So there's no rational reason, if you're a bottom-up investor, you would have invested them in the first place. And the final part, it is really to a very robust IG area, which is the fintech, and removing the monopolies there, which I don't think really affects investors, but hopefully will be a good initiative for China and its consumers. And if we bring, as you say, the tightening of lending this year, really what we should expect in China this year is, its credit impulse or to start to tighten, and so we'll see a reduction in sort of its fixed asset investment and industrial production, but that's going to be more than compensated by domestic consumption, with that pent-up demands bringing back. We can see that in the very strong retail sales and a continuation of strong export growth. And so over the next three quarters, I imagine that on a quarter-on-quarter basis, China will grow somewhere between 6.5% and 7.5% and finish the year annualized above 9%, which is an extremely strong year. I don't know. I've gone slightly away from the question there. I apologize.
No, it's very. I think it's very elaborative on what the policymakers are up to. So there's also a question regarding. I think you have already covered a little bit about that. The high yield versus investment grade. In many emerging markets, high yield issuers in particular led the charge during the first weeks of the year. Do you think it's many people are speaking about it? And do you think it's the year where high yield outshines in the emerging markets?
I think when I think to simplify the question slightly, IG is far more sensitive to government interest rates than high yield. And if you ask me this year, is it easier to make money in interest rates or easier to make money in spreads? I'd say it's easier to make money in spreads because there is abundant liquidity. Global growth is very strong. We can see improvement in balance sheets, and so where interest rates, are battling with central banks that with the strong growth and the inflation outlook. So, in an environment where it's easier to make money in spreads or credit versus duration and interest rates, I think it's right to say that high yield will benefit this year or outperform IG. That's my opinion. Within that, what we're also finding is that, the rating agencies were very quick last year to downgrade and very quick to judge companies in what really has turned into being not a recession so much, but more of a working capital crisis for corporates. So when we look across our double B universe in EM, we can see significant number of metals and miners, petrochemicals, energy companies that we could see them, being upgraded this year. So one of the other advantages I think you're going to find in emerging markets is that cyclical sectors that are driven by the commodity prices, which are going up in the volumes, there's a strong possibility that these are upgraded to IG. Now that's important because you're moving from a smaller investor base to a larger investor base. So that pent-up need to buy these companies will drive prices higher. And the final part is, again, a lot of these cyclical companies were very defensive last year, and they raised cash quickly in case things deteriorate even further. Now they're actually basically using that cash to pay back debt. So we're finding that bonds are being tendered above market prices to move that front-end exposure and use that cash. So there's good opportunities in high yield, more defensive in terms of interest rate movements, and probably more correlated to global growth and asset prices moving up. So overall, yes, we are constructive on high yield versus IG this year.
So let's come to our last question. And our last question is in regards to the outlook of the emerging markets, especially like Asia has inarguably led the way in the process of normalization last year. Are there still enough tailwinds to support this positive backdrop in the year of 2021, according to your opinion? Where else do you see opportunities in emerging markets and why?
You know, one of the first sort of very macro themes was, invest where's recovered from back to pre-COVID growth levels. And if we look at these sort of the three global engines, that would be China, America, and Europe. China, America are now back above pre-COVID levels. So everything related to China and America, directly or indirectly, now really should benefit. And so that puts you into two categories, doesn't it? China, directly or indirectly, is the biggest buyer of commodities around the world. And the US, directly or indirectly, in EM's case, is the biggest consumer in the world, right? So, I think you can benefit across most of the regions. So we like the consumer-linked and export products in Latin America, Eastern Europe, and in Asia. We like the commodity companies in Africa. And we discussed it on a domestic basis where it's consumption driving it. We like the property sector in China especially. So, and obviously one country that, sticks out for America is Mexico, because if the US has a good year, Mexico by definition will have a good year. So we're finding good opportunities in Mexico as well, driven by that strong growth in America. And I guess that's the advantages with emerging markets, because you've got the globe to choose from. You can pick various different plays. You want the rising middle class, the consumer. You've got China and Asia. You want the commodity giants. You've got Latin America. You want these sort of the transportation, the ports. You've got Europe. And so you can find thematic themes to benefit from these two growth engines across emerging markets. And the overall, that environment of reflation, if you think it through, easy liquidity, cheap liquidity, rising commodity prices, and you put it all together, what it means for EM, it means that prices will rise, volumes will rise, defaults will fall, and credit spreads will tighten, in my opinion. So EM's probably, well placed for this environment. And especially if you think about what EM specializes in, which is basically primary and secondary industries. It's not the service sector, which is most affected by COVID.
Thank you, Warren, for being here today and for such a lovely discussion on emerging market corporate debt. In contrast to developed countries, companies in emerging markets have spent much of the past decade reducing their debt levels and thus improved credit positions. Increasing asset allocation to emerging markets, attractive or relatively compelling valuations are factors that have underpinned emerging markets despite a challenging market environment. Hopefully, our audience today will leave better informed and potentially feel excited about the opportunities in emerging market bonds, in particular corporate credit. I hope you all enjoyed today's Portfolio Manager Conference and have a wonderful day and see you next time.
Thank you.
Thank you.
This thing goes.